Scott, I haven't been particularly bullish on this year. I've been thinking we're going to have a lot of volatility. Turns out that a lot of volatility has been on the downside, but I believe that earnings are going to continue to be very strong. If you look at analyst consensus expectations, they continue to raise their outlook for both revenues and earnings. Now, some of that is the fact that stocks do a pretty good job, companies do a pretty good job of being inflation hedges. The revenues obviously go up with prices. But what's really been phenomenal is profit margins are staying at all-time record highs. I think companies are doing a phenomenal job of managing their profit margin, and that's really their number one job. Ever since 2008, my sense has been that companies are managing to the profit margin. I think they're going to find the revenues growth to leverage up with record profit margins. And so I think it's going to be earnings-led. Right now, we're seeing a valuation-led meltdown. But while that's happening, analysts continue to raise their numbers. Now, of course, the analysts don't see recessions happening, so that's my job. I don't think we're going to get a recession this year or next year. And so I agree with the analysts about their optimism for earnings.
Well, you sort of led me into my next question. I mean, I have the greatest amount of faith in the companies of this country, too.
Right.
Maybe they do a better job than the analysts, though, Ed, in the fact that maybe the analysts are a little delusional. With all due respect, not speaking of you directly,
indirectly,
about where earnings are going to go. I mean,
Absolutely.
For real, maybe the analysts just haven't caught up to everybody else yet, and there's no way that earnings expectations can remain where they are.
Well, actually, I think there is a way. As I mentioned before, I think we're going to see $240 a share for the S&P 500 this year and $260 a share next year. And some of that is the fact that as inflation has been going higher, that's been reflected in revenues and in earnings. And the only way it can be reflected in earnings is if, in fact, profit margins are staying at an all-time record high. Look, Scott, we had a slight decline in real GDP in the first quarter. It was a very funky kind of quarter, but the reality is capital spending was an all-time record high. Consumer spending was at an all-time record high. Now, you can come back to me and say that always happens. You always get record highs right before recessions. But maybe I find myself in the uncomfortable position of actually agreeing with Fed officials, particularly Fed Chair Powell, who's recently said consumers are in good shape, businesses are in good shape, the banks are in great shape. There's no particular reason why this economy is going to go into a recession with interest rates having gone up already. So I think inflation is going to moderate. I think that'll help a lot in terms of stabilizing the forward PE. The forward PE came down to about 16, which is what I thought would be the downside of the range. And I think the range is actually 16 to 19 looking into next year. I think you're going to find that companies are going to deliver better than expected earnings, and investors are going to be surprised by that. It's investors that are taking the earnings down, their expectations down.